Ladies and gentlemen, good day and welcome to the Alston & Bird Weekly Client Update. Today's session is Previously Taxed Income. Today's conference is being recorded. At this time, I would like to turn the conference over to Scott Harty. Please go ahead.
Thank you very much. Good morning, everyone, and thank you for dialing in this morning. Again, my name is Scott Harty. I'm a partner in the Federal and International Tax Group here at Alston & Bird. And this morning I'm joined by Jack Cummings again. Thank you, Jack. He's counsel in our group. And this week Jack's joining us to review Notice 2019-1 and talk about previously taxed income. So hopefully you have the slides available now. You should be able to download those. The slides are detailed today, so you may want to be able to flip back and forth between them. So if you can't access those, just shoot us a quick message and we'll make sure you can get those. As always, you can go back and review our prior presentations on our website. I think everything has been fully uploaded there. So if you're interested in a prior presentation, feel free to go and listen to those or download the slides. And also going forward, we have a couple more presentations scheduled next week. We're going to address foreign tax credits, and then after that look at some partnership tax issues as they relate to international matters, and then add a couple of presentations dealing with 962 and the new Section 250 proposed regulations. So we'll have a few more topics forthcoming. As always, as we go through these presentations, please feel free to ask any questions. We will certainly try to address those during the call, but if we don't, we will respond after the call and make sure we address any issues that you might be facing, and we're happy to think through those. So we will try to stay on time today. Let me go ahead and introduce Jack. He's familiar to many of you. He's joined us before. He's counsel in our Raleigh and D.C. offices and served as Associate Chief Counsel Corporate at the IRS. He's also a former chair of the Corporate Tax Committee of the ABA Section of Taxation and a very prolific writer. So Jack, just on everyone's behalf, thank you for joining us. Thank you for presenting on this topic. And with that, I will turn it over to you.
Shortly after New Year's, the Internal Revenue Service issued Notice 2019-1 announcing regulations that will be proposed to address what we used to call PTI, previously taxed earning and profits. Now the notice calls it PTEP, apparently because that term was used in one of the headings in the Section 960, although not in the text of the statute. I think I can't avoid continuing to call it PTI. You may have been a little bit surprised that this came as a notice rather than a proposed regulation. The Treasury has said that it doesn't like issuing notices without the proposed regulation language, but it has done so in a couple of cases, including there were two, I think, Section 965 notices. That was under the press of taxpayers wanting guidance under 965 since tax returns were rapidly becoming due. Here, perhaps there was also somewhat pressure because PTI is already being generated. It was generated certainly in large doses through that Section 965 inclusion, and also GILTI is generating PTI as we speak. And why is PTI so important? We all know the answer to that. The code front loads distributions from CFCs as PTI. So to the extent that we don't have a Section 245 Kappa A dividends received deduction to use, PTI will be important. And if you go on to page 2 of the slides, you will see the heading says, well, maybe PTI is not so important. And as I just indicated, one reason why it may not be so important going forward is the 245 Kappa A DRD, which, of course, only kicks in after PTI applies. And the second reason, one of the two sources of PTI, which is a 956 inclusion on investment in U.S. property, will be less important because of the announcement of the proposed regulation 1.956-1, which basically says that if a U.S. shareholder corporation could have claimed a DRD had the 956 investment been a dividend, then the 956 investment won't be included under 951. So it will not create PTI. The notice, and perhaps if you've just glanced at the headlines of stories about the notice, you've seen that it creates a large number of categories of PTI per year, and that's sort of the headline, and it's a little bit of a head scratcher as to why all this complexity is really needed. Stated reason in the preamble, not preamble in the notice itself, as to why it's needed is because of the different categories of foreign tax credit limitations, and as we know, there are 4 baskets, and then there are multiple ways that those baskets can enter into your tax return as an inclusion. So somehow or other, and we'll see about half of the way that the small number of credit baskets turns into 16 categories, which has to do with the recharacterization of PTI. Next week, Scott is going to cover foreign tax credit, and that will get to some of these issues. Going on to page 4, as I said, 7 of the 16 categories of PTI that the notice describes have one thing in common. They involve some sort of subpart F PTI, and recall that this also includes guilty PTI, some part of subpart F PTI that has been reclassified as section 956 PTI. So, to me at least, understanding the notice begins with understanding the reclassification process. And, we can sort of stop right at the beginning, and you can think that if you and your CFCs don't have 956 inclusions, then you will have escaped about 2/3 of the complication of this notice regime. It's only if you do have 956 investments that you will walk into most of this complication. Now, I realize that 956 investments may have become more common due to the rule we just referred to, in effect applying 245 Cap A dividend received deduction to 956. But so it remains to be seen whether that will be a more common or a less common event. Going on to page 5, I think it's helpful to sort of sneak up on what are the different categories in this notice based on how the profile of the CFC's income might change from year to year. If the CFC only has subpart F income and regular income that's not included currently by the U.S. shareholder, then the U.S. shareholder is going to include the subpart F income under 951, and we know that's going to be subject to the limitation under 952 to its current year E&P. And even if the CFC had previously taxed income, which would necessarily be from an earlier year, that would not prevent the subpart F inclusion. So the subpart F inclusion can create PTI if the shareholder includes it in income. That's the easy case. Now, let's make it a little bit harder. Suppose you've got the subpart F income in the year, you've got other income in your CFC, and you've got a distribution. As we know, the subpart F E&P inclusion is limited to the CFC's current year E&P, and that is not reduced by distributions in the year. Therefore, the distribution that otherwise might be a taxable dividend is going to be eligible to be PTI created in the same year by the Subpart F inclusion. So 959 stacks the Subpart F PTI ahead of other E&P for purposes of characterizing the distribution in the year. Now, let's go to page 6. Suppose we don't have any Subpart F inclusion in the year, but we've only got a 956 inclusion in the year. Unlike the Subpart F rule, the CFC's investment in U.S. property first leads to calculation of the shareholder's 956 amount, and second, that amount may not be included in the shareholder's gross income because it may be attributed to PTI. Recall that a Subpart F inclusion cannot be prevented by PTI, but in contrast, the 956 amount can be prevented by PTI, which creates a fundamental distinction between the two categories of 956 inclusion and the main cause of the complications. Section 956 defines the inclusion amount in a very strange way. It can come from current and accumulated E&P, but only as first reduced by distributions in the year. So unlike Subpart F, as far as 956 inclusion is concerned, the distribution in the year will reduce E&P available to support a 956 inclusion. So first, distributions come out of E&P. Second, the potential 956 inclusion will be reduced by 956 PTI. Not all PTI. Well, hold that thought. Put a finger there. Not all PTI, but just so-called 956 PTI. Subpart F PTI is not really addressed in the 956 definition of the inclusion amount. And this creates what is another source of complication, because the limitation on inclusion of 956 investments is split between the 956 definition and 959. So now let's go to page 7. A little bit more complicated. Suppose we've got a 956 amount and a Subpart F inclusion and other non-taxed E&P in the year. Section 959A says that the potential 956 inclusion will be treated as first from Subpart F PTI and then other untaxed earnings. And it doesn't say it will come first from 956 PTI, second from Subpart F PTI, and then from untaxed earnings. It just says it'll come first from Subpart F PTI for the year. And so it assumes that you know and that you remembered that under the basic definition of a 956 amount, that the 956 PTI has already reduced the potential 956 amount. So, you know, the code is not really serious, or never was serious, about taxing the CFC's investment in U.S. property, because it won't tax it to the extent there's been a prior 956 inclusion. It won't tax it to the extent there's been a Subpart F PTI. It won't tax it to the extent there's been a distribution. And that even includes Subpart F income created in the same year when the 956 amount would have been included, because as you'll see on the last line there on page 7, 959A refers to amounts that are or have been included. The R means the Subpart F inclusion for the current year or have been included Subpart F income in prior years. Well, we've got two more alternatives of the way these things can come up. Let's go to page 8. Suppose there's only a 956 inclusion in the year in the distribution. As we already indicated, the distribution decreases E&P, which is referred to as applicable earnings, available for Subpart F, available for Section 956 amount, and therefore will reduce the potential 956 amount. And finally, suppose we've got the 956 potential inclusion, Subpart F, distribution in the year, and other E&P. We know that the Subpart F inclusion, as we've already stated, is not affected by the distribution or the 956 amount. And we know that the distribution can reduce E&P before calculation of the 956 amount. But 959C applies to the distribution. It comes first from 956 PTI, or the earnings reflected by the 956 amount that was not included because it was Subpart F PTI. This is right here is where the magic happens. The Section 956 amount in the year can reflect Subpart F PTI because of what 956 F1 says. It attributes it first to Subpart F PTI. So the current year E&P first is attributed to the Subpart F inclusion, then to the 956 amount to prevent its inclusion. But to the extent a distribution exceeds 956 PTI, and that's both the original and reclassified 956 PTI, it can be shielded by Subpart F PTI, which could be recharacterized from Subpart F to 956. And again, as I indicated, that recharacterization is at the heart of most of the 16 categories in this notice. Now, let's try to climb out of the existing rules and get to the current proposal, but we can't avoid looking at this example in the current regulation, because if you've never looked at it, I challenge you to grasp it upon the original reading. The example involves CFC-M, which owns CFC-N. And CFC-N, the lower tier CFC, has $60 of Subpart F income in a prior year. So we've got a $60 inclusion by the U.S. shareholder. Then in a later year, N does two things. It invests $20 in U.S. property, which looks like it's going to be a 956 inclusion. And it distributes $45 to M, which at the time would have been a Subpart F inclusion. You might look at that and say, well, there's already been $60 of PTI created by the earlier year $60 Subpart F inclusion. So I know that we can't have, I know that $45 that goes up to M could not all be a dividend, because N only had $60 of E&P to begin with, even though it's PTI. And yet the example says there's a $45 dividend. You say, how could that be? 20 plus 45 is 65. 65 is 5 more than 60. So how can we get an extra $5 worth of taxable E&P, or at least, how can we get $45 of dividend out of, when added to 60, when added to the 20, out of $60 of earnings and profits in the earlier year? And the answer is that the $20 investment in U.S. property is, of course, PTI. It's Subpart F PTI that's recharacterized as 956 PTI and does not reduce earnings and profits. That's the underlying point, meaning that when N distributes $45 to M, it can pay a $45 dividend. Now, that dividend, again, can be previously taxed income, but it's still a dividend. This example is intended to illustrate the recharacterization of Subpart F PTI to 956 PTI, which again underlies the 16 categories in the new notice. Going on to page 10, there's only one point I want to make on page 10 because it's supposedly reciting what we've already said. It's the last point. You're asking yourself, okay, well, why do I care about all of these flavors of previously taxed income? If it's previously taxed income, I'm not going to include it, right? Isn't that the end of the story? Well, no. Previously taxed income can bring up foreign tax credits. For example, on an inbound distribution, there may be withholding taxes in the year of the distribution that were not associated with the earnings and profits, in the prior year that underlie that distribution and turn it into a dividend. So those credits could be brought up. But we've been focusing on the 956 inclusion. And the last bullet point here was one that is a little bit of a surprise. A 956 inclusion, assuming it's not PTI and it produces an actual includable amount for whatever reason, cannot support a foreign tax credit, even though historically 956 inclusions have supported foreign tax credits. That's not directly related to this 16 regime notice, but it's the other important point or fact about 956 inclusions. Going on to page 17, just that statement there, the long quotation, is how the notice describes the existing rules, which is basically what we have spent the last 15 minutes going through. And I don't know about you, but I cannot get all the complication of the existing rules out of that little paragraph, but that's all the notice really tells you about the existing rules. Notice, however, the last line, which says, see Notice 88-71 for the annual accounts that are required to be maintained for separate categories of income described in 904. Well, it turns out that the root cause of these 16 categories that the notice says it's going to create is in the 1988 notice. A 31-year-old notice that has never been turned into a regulation is what the government is still working off of and underlies the categories here. So going to page 12, the notice explains that these 8 categories listed here are the ways that 956 PTI can arise, and they must be tracked. Now, notice that most of these are subpart F, the second one, for example, ordinary subpart F PTI reclassified as 956 PTI. So the last 7 are basically reclassified subpart F type PTI that becomes 956 PTI, and as I indicated at the top of the discussion, that's the cause of most of the categories. Finally, on page 13, recall that a lot of this is going to relate to GILTI because, as Scott might want to expand on, GILTI is going to just make PTI the gift that keeps on giving, because GILTI is going to cause virtually all of the foreign corporate CFC's income above the QBI return to be included in the U.S. shareholders' current income. And because GILTI is not limited to current year E&P, let's underline that. GILTI is not limited to current year E&P. It is not like subpart F income. It can actually be more than E&P. And when it's more than E&P, it can cause the so-called 959C3 account to go into deficit, which is going to be sort of a new thing under the sun for those who thought they were familiar with the three categories of 959C E&P. Finally, on page 14, notice that the regulations will apply to years of U.S. shareholders ending after the date of the publication of the notice. That's different from some of the proposed regulations that go back to the enactment date. But as in most of these, which have a delayed effective date, taxpayers can rely on them. And presumably taxpayers are going to rely on this notice because there's not too much else out there. Scott, I hope that next week when you go to the foreign tax credit that you will make clear some of the questions that I have left on the table.
We will certainly do our best. I think one point that may be worth making, let me go back to this slide here on, I think it's slide 12. We talk about the reclassification of the PTI as 956, and I think this is probably relevant for lenders and borrowers in financing transactions. Given the regulations, which essentially give or turn off 956 for U.S. corporations if they would otherwise get 245 Cap A deduction, the question for lenders and borrowers is, can I get a guarantee from a CFC for a U.S. corporate borrower's debt, which obviously lenders are trying to get as much collateral and security as they can. And historically, companies have not been wanting to do that. You do 2/3 stock pledges just because of 956. So that's very common in documents, and I think that mindset still carries over today. But I think the question for a lot of borrowers and lenders is 956 still a concern, or can you get guarantees from CFCs where really all of this income above, like you said, the Q-buy return, it's all guilty or sub. I mean, it's being taxed. You're creating PTI. So is there really any? What's the exposure for a borrower under 956, a corporate borrower under 956? So are lenders in a better position to get guarantees from their borrowers or the CFCs of the borrowers, where 956 has effectively been limited in its application? And even if you're talking about the Q-buy return that's so-called sheltered, did you get a 245 Cap A deduction anyway for that? So I think this is something that certainly we're seeing now in financing transactions, and there's still vestiges of, well, no, we'll just do 2/3 stock pledges. But if you really dig into the numbers, I think it's helpful for both lenders and borrowers to look at what are the real implications under 956 now. Maybe tracking these accounts is worth not doing it, but and maybe this, it's a lot of work to have to do. But I think you'll probably see more pushing to get guarantees under 956 just because it's much more muted under current law. But we will, Jack, definitely address a lot of the issues that you raised on the foreign tax credit side next week. And so hopefully we can answer some of those questions. I think we will. If we don't have any questions now, then I think we will plan to speak to you all next week. Thank you all for joining us. Next week we will do foreign tax credits. And if you have any questions after the presentation, always feel free to email me or Jack, and we will get back to you right away. So thank you very much for joining, and we appreciate your participation, and we look forward to seeing you next week. Thanks.
Ladies and gentlemen, this concludes today's call. Thank you for your participation. You may now disconnect.